Mauzo Limited, that is question 3 of the handout. Mauzo Limited is a private company. The company manufactures toys and infant clothing. On 1st of October 2015, the company imported an assembly plant at a cost of 2.5 million. The plant was estimated on that date to have a useful life of 10 years and a nil residual value. Depreciation is provided on a straight line. So they bought an asset on 1st of October 2015 at 2.5 million, and the asset is expected to have a useful life of 10 years. On 30th November 2017, a competitor was awarded a license to import similar toys and infant clothing, resulting in a significant reduction in the market share. On 30th of September 2018, the fair value of the machine was shillings 1 million, and the cost to sell are estimated at shillings 150. On the same date, it is estimated that the machine will generate Kenya shillings 325,000 per year over the remaining useful life, which was unchanged. On 31st August 2019, the competitor's license was withdrawn after contravening the NEMA regulations. As of 30th September 2019, the value in use of the machine significantly exceeded the carrying amount and is estimated at shillings 3 million. Discount rate is 20%. You are required to ignore the deferred tax. Required, compute the impairment loss to be recognized on 30th September 2018. So to calculate the impairment is the difference between the book value, which we are calling the carrying amount of an asset, and its recoverable amount. So we are requested to calculate impairment on 30th September 2018. 30th September 2018, that is the financial year when the competitor was awarded a license. So you know, when a competitor has been awarded a license, the market share will go down. Reduction in market share is most likely to cause impairment because your goodwill might go down. So when assessing the carrying amount, you will take the cost. The cost of the plant on 1st October 2015 was 2.5. But to get the book value, you subtract the accumulated depreciation. So we subtracted the accumulated depreciation, which is 2.5 divided by the 10 years. Useful life was 10 years. But from 2015 to 2018, that was 3 years. So accumulated, we multiplied by 3 years, we subtracted, we got a carrying amount or net book value of 1750. Then recoverable amounts. Recoverable, how do you get recoverable? You check the net realizable value versus the value in use. So net realizable value is the market value. They said currently it will be sold at 1 million, but you will incur 150 to dispose of that particular asset. So the net realizable is the market value minus the disposal cost, which is 150. So net realizable, we got 850. However, in the event that you continue using the asset, if you continue using the asset, they were saying it will generate a constant cash flow per annum of 325,000 for the remaining useful life if they continue using it from 2018. So from 2018 moving forward, the remaining useful life is 7 years. So if they continue using, remember now this is an annuity. So annuities, you take the cash flow itself times 1 minus in bracket 1 plus R raised to power negative n divided by R. That is from your financial management. This is how we determine the present value of annuities. So you gave me a figure of 1171,492. So to determine recoverable, you check the realizable vis-a-vis the realizable, or if you continue using the asset. But continuation, you have to bring it to present value. So we noted out that the best is to continue using the asset, because from usage, you generate a cash flow of 1.1, having taken the value of money into consideration. So the impairment will be the 1750 book value minus the recoverable, which is now whichever is higher between these two. We got 1171. So subtraction, we got impairment to be 578, 547. Then for those who are there is something we wrote below that. We said that after impairment loss has taken place, any subsequent, after impairment loss has taken place, the recoverable amount becomes the carrying amount of that asset. And by extension, we say, if you have the book value, book value is what you wrote in your financial statement. So we wrote that the asset should be 1750. But the reality on the ground is that this asset, the best of the best it can get us is 1.1. So moving into the future is today, which is 2018, for the remaining 7 years, what you should recognize in the books as the book value of that asset is 1171 and not 1750. When you have recoverable and the initial carrying amount, recoverable now supersedes the book value. So anywhere we shall be required to bring in the cost or the value of the asset from 2018 moving forward, you consider the 1171 and not 1750. That is noted. So let's go to Roman 2 of the question. Roman 2 now, they were saying we calculate the reversal of impairment on 30th September 2019. So how do you calculate the reversal of impairment? Now let's read there. So let's take from there. Reversal of impairment. How do you determine? Just to refresh on that, an asset is an impairment is said to have reversed when that condition which had initially caused impairment is no longer there. Like in this case, what caused impairment is the competitor being awarded a license. That is what caused impairment, because anakuja kutampa na market share yetu. Then ahead there, we were told they contravened the NEMA regulations and their trade license was withdrawn. So that withdrawal of license is now what will cause the impairment to reverse. What had initially caused impairment is now not there. So it has reversed. So you come here and say reversal of impairment is the carrying amount assuming no impairment took place. So you will check what would have been the book value in the event that no impairment had initially taken place, minus the carrying amount in the impaired states. So you will check the book value, the true book value, now that the asset is impaired. So have that formula. So let's start with this one here. Carrying amount, no impairment. So assuming there was no impairment at all in up to 2019, now we are checking 2019. So it will be the cost of the asset, remember, was 2.5. Less accumulated depreciation. So accumulated depreciation is 2.5, would have been 2.5, and the useful life was 10 years. But now up to 2019, because we are assessing it in 2019 financial year, now you will multiply by 4. You multiply by 4 years. Because from 2015, assuming hakukuwa na mambo ya competitor and anything, in 2019, so no impairment took place, now we are in 2019. So up to 2019, you multiply by 4. Remember impairment, the initial one we assessed 3 years because it was up to 2018. But this one we are checking in 2019, so that is 4 years. So can you work that and give me the answer? Work out that and help me the answer. How much is the accumulated? $1 million. Thank you, Nancy. So Nancy says accumulated would have been 1 million. Therefore, the book value assuming no impairment will have been 1.5. So how that? Then now, let's check. Let's check the book value in 2019, now that impairment took place. So you say carrying amount impaired state 2019. So 2019, the cost, remember impairment, right? That. So the cost, once impairment has taken place, the recoverable now becomes the new value of that asset. So the one we are going to impair, give me that answer there. The one we got, the recoverable, 11 something. Give me that figure deleted. So the recoverable becomes now the cost of the asset. Recoverable amount. That is now what you consider, which I told you Once impairment has taken place, recoverable becomes now the cost of the asset moving into the future. So you don't go back to the initial cost. Now that is the true value. That is what will depreciate for the remaining. So someone to give me that figure, I deleted. Joy, 1171. 492. So this one becomes like now the cost of the assets. Less accumulated depreciation. Remember now this was in 2018. So less accumulated depreciation. So less accumulated depreciation, you will take 1171, 492, divide by the remaining useful life. Remember, this was valued in 2018. So the remaining useful life will be 7 years. Because initially it was 10. Initially it was 10. But up to the point the impairment took place, which made it to be 11, was 3 years. 2018, 2015 up to 18, 3 years gone. So the remaining we are checking 7 years ahead from 2018 onwards. But you know this one here, assuming no impairment, we brought it all the way from 2015. So don't confuse between the two. Then you multiply by 1 year. Why the 1 year? Because this value is 2018. We are checking this in 2019. So 2018, 2019 financial year. But this one 4, because this one we are pulling all the way from 2015. 2015 all the way to 2019. But this one we are pulling only from 2018. We are bringing it from 2018 to 2019. So don't confuse between the two. Give me that answer. You round off to a whole number. You round off to a whole number. Let's round off to a whole number there. So that is answer 167, 356. 167, 356. So subtract. So the carrying amount will be how much? 1004, 1004, 136. Correct. Thank you. So the book value in 2019, because you know impairment took place. This is the correct book value right now as we speak. But now when you walifanya tumeumia, because you know now this one, this true value is based on the impaired amount. That is the recoverable. If at all the competitor, mute yourself, Yamosi. If at all the competitor never came, the book value would have been 1.5. But now they came, the asset was impaired, the correct book value is 1. But now they are packing, they are leaving. Now that they are leaving, whatever you had lost, in answer, you start recovering, pole. You start recovering, pole. So what you are recovering, which you have lost, that is what we term as a reversal of impairment. So to get the reversal, you take the carrying amount, assuming no impairment, 1.5, minus the carrying amount in the impaired state, which is 1004. So the difference is what you had lost, which now you will recover. you will get it back because the competitor you are going to have the market dominance again. So you say down there, therefore, reversed impairment is equals to 1.5 minus 1004, 136. How much do you get? The difference between the two, between this one and this one, that difference. That is what you are recovering. So Nancy, 495. I don't have space to add the apple. 495, 864. Correct. So we have answered Roman 2 of the question. Unless you have a question, bring it up. Sawa. So no question. We go to the last one. The last one, they want us to prepare the profit and loss account extract for 2016 to 2019. Also, they want us to prepare the statement of financial position extract. Extract means just the portion you income and expenses you can see, assets and liabilities which you can see. So not the entire thing. So right there. So you write there, Mauzo Limited, extract of the statement of profit or loss. Extract of the statement of profit or loss for the years ended. I think it's 30th September. I believe so. They want for 2016, 17, 18, and 19 for those years. So shillings there. Yeah, they want the extract for those financial periods. So P&L, you just check income and expenses which you are capable of seeing. So for the income, which I'm seeing is the reversal of impairment. When impairment reverses, it is treated back as other income. other income actually in the financial statement. Actually, the name income will not be very good for me. I need to bring it as other. Other income, which is ideally other comprehensive, but just like other income. So, because you know when there is impairment, you recognize an expense. If it reverses, then it is treated back as other income. So, reversal of impairment. Reversal of impairment. It reversed in 2019, the one you have just given me right now. Reversal took place, that was 495 or 95, 864. The one we have just calculated a few minutes there. So it reversed in that year. And that is the only income we are capable of seeing. Expenses, which we can see, one, there was depreciation. So depreciation was uniform up to 2018 because we divided by 10 years, 2.5 divided by 10. But 2019 depreciation is different. We divided by 7 years. So this one I'll take 250. It was 2.5 divided by 10. So every year you consider 250, 250, 250. You will help me with the one for 2019. 2019, I'm not sure, but Nancy had given me an answer here. 167, confirm to me. 167, 356. I hope it is the depreciation in 2019, the one which was based on 7 years on the new recoverable amount. I hope that is the value. Don't copy, make sure you are seeing everything where they're coming from. Yeah, good. Then impairment itself is an expense. So impairment loss. Impairment took place in 2018. So please remind me how much was impairment. It took place here. How much was that impairment? You could answer up. Help me that answer. What was the impairment in 2018? You're 578. 578. 578. 508. So now the examiner, when it is an extract, there is no need of adding or subtraction. But if you wish to, you can have here. If you wish to do that, then you can add these total expenses. But for 2019, remember to take this minus this because this is an income. So if you are adding, make sure you are keen on that. But extract, there is no need of addition. You just leave it like that. They just want to see the income and expenses, which are in that particular question. So no need of disturbing yourself with those additions and subtractions. But if you so wish, then you subtract, you take this minus depreciation. So that is the extract for P&L. When up that, then we go to the balance sheet. I tend to believe that you are done. So let's go to the extract of the statement of financial position. So right there, Mauzo Limited, extract of the statement of financial position. Of course, this one you say as at 30th September. Like that. So how that? All right, good. I hope you are done with that. So non-current assets, it was a plant. It was a plant. So the plant, first of all, I want to bring it at cost. 2.5. It was 2.5 up to 2018. But 2019, give me the recoverable. Recoverable now becomes the value of the asset. It was 1171,492. The recoverable, immediately after impairment, then the recoverable becomes now the cost or the new value of the asset. Then you less accumulated depreciation, less accumulated depreciation. So accumulated depreciation was 250. You accumulate, so add for next year. Next year was also 250, so it will be 500 when you accumulate. Add for next year again, another 250, coming to 750. But now, the other year was not 250. The other year was, I don't know how much. Angalia depreciation for 2019, iko hapo juu kwa P&L. That is the one we need to add. I think it was 167, 356. So take 750 plus 167, 356. Can you add and tell me the answer? The accumulated for 2019. You add the 167 to 750. Joy, 917, 356. Good. Then there was impairment. So less impairment. No, we let's that will waste our time. Just say impairment. Impairment. Don't even mention loss, just say impairment. So in 2018, there was impairment loss. In 2018, let me retrace figures, 578, 508. 578, 508. While in 2019, there was a reversal. There was a reversal of 495. We got hapo juu, hizo answers are there. 495, 864. 495, 864. That one you add back. Reversal, you add back. Reversal is cover evaluation. The asset is gaining value. So reversal, you add back. That is why I never wanted to mention loss or reversal. So impairment, this was the loss. This is the reverse. So reverse, you add back to the asset. Therefore, the carrying amount of the assets carrying amount. So can you finish for me that? 250 minus that. And yeah, that one you have to do. Give me all the figures across. Don't put just for your own sake. Chapa mpaka mwisho. Can one person confirm that you are done? Just one person can confirm. So thank you. So I hope we are all done. So I want you to take out the past papers. For those who do not have physical copies, you can still rely on online, but I don't want you to rely on online. Either you pass through the college, you pick physical, or please just print it at your convenience. You have to sequence to Kisumbuka sana. So November 2020, question 5C, sorry, question 1C. People gotten the 2020 question 1C? Question 1C of 2020. No matter which page, I know mine is different with the current one. Sijapata the updated page 61. So check page 61. So it says, and maybe allow me to wrap this first. So allow me to read the question. It says, ABC Limited owns a machine which originally cost 10 million. So the cost of the machine is 10 million. The accumulated depreciation associated with the machine was 2.5 million as of 31st December 2019. A machine engine assessed, a mechanical engineer, a mechanical engineer assessed the machine in early January 2020. The engineer's report stated that similar damaged machine had sold for 1 million in the recent past. In addition, due to the machine's unique nature, significant advertising cost of 100,000 will be incurred to find a buyer. The machine was not covered by insurance. A power surge during the year ended 31st of December 2019 reduced the machine's production capacity and shortened its expected life. ABC Limited's management accountant estimated that the damaged machine will generate cash flow of 3 million per annum over an expected remaining useful life of 3 years. ABC's limited cost of capital is 9%. No impairment of machine had been recorded in the accounts. Required, in the context of IFRS number 36, impairment of assets, outline the necessary accounting treatment of the machine given the above information. Note, the present value interest factor of an annuity of Sh1 per year at 9% for 3 years is 2.5313. So Washa to pair will not now waste out, but we can just check. Just check for me in your calculator if it is true, but once you have been given, there is no need of testing. Just check for me 1 minus cost of capital 9 for 3 years divided by 0.09. Can you check whether it is giving us the 2.5313? Because this is how we determine present value of annuities, the constant cash flows. So can you check if that's true? Check if that is true. Yeah, confirmed. So, but there is no need of one they give you where you are just being curious. So they are saying we outline the necessary accounting treatment. So write for me there. Let's write down there by you saying, write by saying IAS 36. So today at least we have upgraded, not today, now moving to the future. That Zoom now will not be stopping after 40 minutes. That one also means now things are serious. IAS 36 provides that an asset, IAS 36 provides that an asset should not be carried, in the financial statements, should not be carried in the financial statements should not be carried in the financial statements at an amount more than its recoverable. At an amount more than its recoverable value. An amount more than its recoverable value. Full stop. Full stop. Another hyphen down there. Another hyphen, you say, if the carrying amount exceeds the recoverable, if the carrying amount exceeds the recoverable amount, then the asset must be impaired. Then the asset must be impaired. The asset must be impaired. Full stop. So that is what the standard requires. So it is now our duty to try and check whether this asset is impaired. So carrying amount down there, you say the cost of this asset in question was 10 million, while the accumulated depreciation less accumulated depreciation, which they said was 2.5, meaning that the book value of this asset was 7.5. So that is the carrying amount. That is the carrying amount. So have that. Correct. Let's check recoverable. So before recoverable, let me say fair value minus cost to dispose. That is the net realizable. Net realizable value. How much was this? Did they provide? A machine, after the machine in early, the engineer reports damage had sold for 1 million. In addition, due to the machine's unique nature, significant advertising costs of 100. So this one will be 1 million minus 100. There is advertising cost. Imagine your asset is having a book value. According to you, the book value is 7.5. Alafu anakuambia assets kama hizi, you know they have said similar assets. So if similar assets are being sold at 1 million, we also assume ours will also go for 1 million. So ile umeenda na hiyo asset yako huko, unasema yangu iwezi enda chini ya 7.5. Wanacheka wanakuambia assets kama hizi hata jana zimeuzwa hapa at 1 million. And for your information, we have to incur extra 100,000 to advertise. So it means that the market value for that asset right now is 900. Then you will have a second opinion. Should I continue using the asset? Because from 7.5 to 9 is practically impossible. So value in use, if you decide to continue using the asset for 3 years, they say you will generate a constant cash flow of 3 million per annum. Check a certain paragraph down there. So they said you will generate 3 million. Then you discount to present value, and the present value interest factor at 9% was 2 so you multiply by 2.5313. So tell me what you get. This times that. So that I'm multiplying by 2.5313 because of the present value issue, so that we can determine the present value of that amount. So can you discount and give us the answer? $75.93. $75.93, 900. So whichever is higher. Okay, let's continue using our side. Cannot work for us. So this is the recoverable. Recoverable amounts. For recoverable amounts is that one there. So impairment loss is equal to the carrying amount, which is 7.5, minus recoverable ni kubwa. So in the event that you are recovering more, you can recover more than the book value, then the asset is not impaired. Don't recognize negative. We don't have negative impairment. Asset cannot be negatively impaired. The rule is there is impairment or no impairment. Now, to say that in the reverse, apana, it has not reversed. Reversal only takes place if there was whatever the cost is no longer there. But in this case, the market, not market value per se, what you can recover is more than your book value. If we humble ourselves, then we'll say the asset is revalued because you are getting more than what you had recorded. So there is no impairment. And it is ideal for you to write for me down there. The recoverable amount of the machine, we are writing. The recoverable amount of the machine. The recoverable amount of the machine is higher than its carrying amount. Is higher than its carrying amount, and therefore, no impairment should be recognized. Therefore, no impairment should be recognized. No impairment should be no impairment should be recognized, full stop. Correct. So we have solved that. We have solved that. All right, so down there, I want you to write for me disclosure requirements under IS 36. Disclosure requirements. James Jamosi, wewe ulikuwa unataka sana physical, sio? Of late naona uko sawa kabisa. Ama is there any issue? Tumechukua 1 minute break. Are you very comfortable? How is the online moving? Immaculate, are you much comfortable? Ama we turn kutanange uzime online tupatanange physical? Tuko break, so we are just making stories. Yes, James, you have unmuted, you can say something.
I am okay, but sometimes the first time it was taking time to that I cannot hear you talking, but it came later on Wednesday, Thursday.
Now I have solution to that, because I was not recording the class initially because of that thing, which after 40 minutes going off, so recording continuous recording was difficult. But for now, you see I'm recording continuously. So in the event that there is something we did not get, I will share the recording, so you can just connect that space which maybe was an issue.
But on Saturdays, I won't be able to log in because I'm going to judge. So you can record on so that
I'll be recording all of them. I'll be recording all of them, James. All of them except none. So
yeah, it's okay.
So for James, tumesaidiana. Anyone else? Murunga, I think I'm seeing for the first time. Immaculate, Joy. Any challenge on individual capacity? Are we okay being online? Mwende, Nancy, Vera umenyamaza. Immaculate anasema yeye ako sawa kabisa. Yeah, it's quite convenient, because the only problem maybe I've experienced with students, most of those who are in early morning, you find some people are mtu ana prefer kuja physical in town because he or she works in town. So kuja mapema town, alafu ndio aende kazini. So online in the house means this person must stay up to 8. That's the only challenge I got. But hata hiyo kuna remedy. In every class kuna computer. So inafunguliwa hapo, in case you are there, you will still attend it from there. Because wengine pia wataki employer aone ati anafika 5 in the morning and attend classes from the office. So unaenda tu shule as usual. Every class, in all our classes, there is computers in every class na speaker. So inafunguliwa tu hapo. We just proceed as usual. So let that inconvenience not be there. Thank you. That was our break. So we proceed with the disclosures. So any moment we talk of disclosures, what we are talking of is, what are you supposed to tell us? What are you supposed to tell us when it comes to impair? If your asset is impaired, what exactly are you supposed to tell the users of financial statements? So disclosure is just what you need to tell the users of financial statements in regards to the task under consideration. So the task here is on impairment. What should you tell the users of financial statements in regards to impairment? So number one, we are writing, number one, impairment loss recognized. Impairment loss recognized Impairment loss recognized in the profit/loss accounts. In the profit/loss accounts. Number two, impairment loss recognized. Impairment loss recognized in other comprehensive income. Recognized in other comprehensive. In other comprehensive income. Have a small icon up on the layer. You say something small. You say these are impairments on revalued assets. These are impairments on revalued assets. On revalued assets. On revalued assets. Number three, reversal of impairment. Reversal of impairment recognized in the profit account. Reversal of impairment recognized in the profit account. And finally, reversal of impairment. Reversal of impairment recognized in other comprehensive income. Reversal of impairment recognized in other comprehensive income as a result of revaluation. As a result of revaluation. Reversal of impairment recognized in other comprehensive income as a result of revaluation. Full stop. But, you know, whatever we have done, yes, whatever we have done is a impairment on cash generating assets. Ideally, it is not good to assess impairment on assets which are not generating cash flows, because if the asset is not generating cash flow, you might get challenged when it comes to recoverable. Because recoverable, you check the fair value, the net realizable right now, vis-a-vis you compare with the value in use. So value in use, you expect the cash flows so that you can discount them to present value. So in the event that you don't have cash flows, it means you can purely rely on, you will only rely on the net realizable value. So the questions which we have been doing, or under IS number 36, IS 36 only focuses on cash generating assets only. But what about for the assets which do not generate cash flows? They are there. There are some assets which do not generate cash flows, like which one? Research centers, for example, like government research centers. Hakuna cash flow they generate. Check out huko kwenye tulikuwa tunapelekwa ilikuwa methodological sijui what huko wanafunzi wanapelekwa. Ile pesa tulikuwa tunatoa ni walimu wanakula. Ati basi na sijui nini, a lot of unnecessary stories. But hapo hakuna pesa. So if the asset is not generating any cash flow, then determination of impairment is not under the scope of IS 36. IS 36 is not focusing, let me not even use the word much, it's not focusing at all on impairment in regards to non-cash generating assets. For non-cash generating assets, impairment is assessed using IPSAS. IPSAS is the International Public Sector Accounting Standards. There is no IAS, you know, IAS, IFRS, those ones relate to private commercial entities. For non-profit making and public institutions, we normally apply IPSAS. So mostly though not always, you will find private institutions, their assets, most of their assets are cash generating. You cannot be private and work on an asset which is not generating any cash flow. For what purpose? So for non-profit making and public institutions, there are assets which are there, but their main intention is to serve the public, but not to generate cash flows. So those assets, they also undergo impairment. Let's use this other one. Moment people are running away from any asset, even if it is not generating cash flow, it is high time you need to assess whether there is impairment. So impairment of assets which are not generating their own cash flows is covered under IPSAS, because IPSAS, okay, it's a perception that private entities, they cannot have asset which is not generating cash flow. So we cover it under IPSAS because IPSAS is for public institutions and for non-profit making entities. To that effect, we are going to a subtopic. Though in the syllabus there are need two topics separate. The impairment under IPSAS, the course outline, there is impairment under IPSAS and there is impairment under IS 36. They are two different topics. But to avoid how in future, let me just cover impairment as one. So I'm bringing it as a subtopic, but not a topic. So right there, IPSAS 21. IPSAS 21 and 26. Impairment of cash and non-cash. Cash and non-cash generating assets. How that subtopic. So let's write, you say, a cash generating asset. A cash generating asset. A cash generating asset is any asset. A cash generating asset is any asset held. Is any asset held by a government business enterprise, held by a government business enterprise, GBE, government business enterprise, with the primary objective, of generating commercial returns. Primary objective of generating commercial returns. I repeat, a cash generating asset is any asset held by a government business enterprise, in bracket GBE, with the primary objective of generating commercial returns. Generating commercial returns. Full stop. Another hyphen. A non-cash generating asset, on the other hand, non-cash generating asset, on the other hand, a non-cash generating asset, on the other hand, non-cash generating asset, on the other hand, is any asset held by a government, held by the government without any objective, of generating commercial returns. Any objective of generating commercial returns, e.g. research centers. E.g. research centers. Full stop. Just a minute. I check something in 2021. We'll go to just a minute. I was looking for something which apparently I cannot see it there, but fine, it will come. So we are saying a cash generating asset is any asset which is held by the government, business enterprise, GBE, with the primary objective of generating commercial returns. So that is almost similar to what we have been doing under IS 36, those which are generating cash flows. Then non-cash, the objective maybe is just to provide services to the public, but no commercial return behind it, like research centers. So there is this new term, because I've ever seen, that's what I was looking for. I've ever seen it being asked, and as allow me to kill it at this stage. GBE, what is a government business enterprise? What is a government business enterprise? So I want us to write it there, though it's not supposed to come there, but I want to fix it under this. So write for me down there. Write for me down there. A GBE is an entity. A GBE is an entity with either of the following characteristics. An entity with either of the following characteristics. Either of the following characteristics. With either of the following characteristics. So there are like 5. So Roman 1 is a government entity. Is a government entity with the power to contract in its own name. A government entity with the power to contract in its own name. Is a government entity with the power to contract in its own name. In its own name. Number two. Number two. Has been assigned the financial and operating authority, has been assigned the financial and operational authority, to carry on business. To carry on business. Number three, sells goods and services, in the normal course of its business, to other entities, at a profit, or at full cost recovery, Number four, is not reliant on continuing government fundings, to be a going concern. Is not reliant on continuing government fundings to be a going concern. And last, number five, is an entity controlled by a public sector, is an entity controlled by a public sector, is an entity controlled by a public sector entity, or government itself. Full stop. Down there you say, example of GBE are the parastatals. Parastatals are GBEs. Yeah. So, you will pick up to you, but that is what they normally ask there. In relation to it says 21, highlights the characteristics of a government business enterprise. Or what is the meaning of a government business enterprise? The simple definition of a business government enterprise, you can pick from any of those characteristics. Is a government entity with the power to contract in their own name. Is an entity controlled by a government sector, institution, or government itself. Whichever of those all those characteristics defines what is a GBE. Note. Tutarudi huko kwa impairment, but nimetoka nje kidogo, but they are relevant because it is the GBE and another one called GGS. GGS, which carries out this impairment, those government institutions. So you say GBE, Government Business Enterprise, Government Business Enterprise, differs with the general government sector, differs with the general government sector, in bracket GGS, differs with general government sector, GGS. Full stop. Weka ka hyphen hapo. Put an hyphen down there. You say general government sector, general government sector is a group of government controlled entities. General government sector is a group of government controlled entities. Government controlled entities that provide services. Which are mainly non-market in nature. Which are mainly non-market in nature. Full stop. Another hyphen. The main objective is to include all the government information. The main objective is to include all the government information in the consolidated financial statements. Another hyphen. IPSAS 22, IPSAS 22 requires a GGS. GGS is the general government sector, to provide the following disclosures. Number one disclosure, assets by major class, showing investments in different sectors. Number two, liabilities by major class. Next, net assets stroke equity. Net assets stroke equity. Net assets stroke equity. Next, total revaluation for the period. Next, expenses by major class. Next, surplus or deficits. And finally, Finally, cash flow from operating activities. Cash flow from operating activities. Cash flow from operating activities. Investing. Cash flow from operating activities, comma, investing and financing activities. And financing activities. Full stop. Down there, you say September 2021, question 4B. September 2021, question 4B. Someone tell me the page, I want us to check on it. Mtu amepata hiyo swali, niambie which sitting is that? Page 51, well, so check page 51. Check page 51. So I believe everyone is at page 51, and I read it says, in the context of international public sector accounting standards, that is interest number 22, disclosure of information about the general government sector. Explain the term general government sector, GGS. So general government sector, we have just said, is an entity of the government, in simple words, an entity of the government whose main objective is to provide services which are not non-marketable in nature. So there is no monitoring. I used to give example with roads, like the roads using the Olympic Expressway. But their main purpose, Huduma Center, whichever. The main aim is an entity of the government whose primary objective is to provide services which are non-market in nature, non-monetary, non-cash in nature. Identify the disclosures that should be made in respect of the general government sector. So the disclosures hizo nimewapea. Hapo unaenda angalia tu balance sheet venye inakaa before ufikirie hizo zingine. They need to tell us their assets. Hata kama usahau hiyo mambo ya major class, the assets of that GGS. They need to tell us their liabilities. They need to tell us their equity, which is the net assets. Unaruka unaenda kwa P&L, unaongelea mambo ya their expenses, unaenda kwa cash flow, operating, investing, and financing activities. So that will give you 8 marks. So what you need to know is how to separate these two. There are things I've seen them being asked. The GGS and the GBE, they are more or less the same. They have small distinctions that GGS, they provide non-cash or non-marketable services. This one, hata wanafanya biashara kama KPLC, let's not go much into the story. So I'm coming back to where we were, but it is revolving about the GBE and the GGS. So we are still in the same place. So write for me down there. The principal issue, ile muhimu kabisa, is on how to determine the value in use. Is on how to determine the value in use. Here too. That is the principal issue under these two standards. How to get value in use, because You know, value in use is the discounted cash flows. And you see there are some assets in this case which are not generating cash flows. So the main issue is how to get the value in use. So right for me there, A, we are going to have A and B. So A, for a cash generating asset, for a cash generating asset, just a minute. But it's not ready. So for a cash generating asset, the value in use is the present value. Value in use is the present value of the estimated future cash flows. Present value is the present value of the estimated future cash flows expected to be derived from the continuing use or usage, continuing usage or continuing use, and continuing use. Expected to be derived from the continuing use of the assets. Continuing use of the assets and from its disposal at the end of the useful life. At the end of the useful life. The end of the useful life. In brackets, IPSAS 26. Yeah, that is IPSAS 26. So here, equal to sour. That is the same with IF number 36. That is for cash, the cash we are not even coming to do it here. They are the same. The approach remains the same. You just discount the expected cash flow. The main issue is now this IPSAS 21 for non-cash generating units. How will you get the value in use? So write down there. B, for non-cash generating assets, in brackets, IPSAS 21. For non-cash generating assets, in bracket, IPSAS 21. The value in use is the present value. Of an asset's remaining service potential. The present value of an asset's of an asset's remaining service potential. Assets remaining service potential. Full stop. Full stop. Down there you say, this is determined using either of the following approaches, 3 approaches. This is determined using either of the following 3 approaches. Determined using either of the following 3 approaches. So for assets which are not generating cash flow, there are 3 approaches we normally use to get the value in use. We have 3 approaches. So this is determined using either of the following 3 approaches. So we are going to highlight approach 1, 2, 3, but I'm stopping there. That is where we start from. I don't want to bring them now. We want to bring them. We discuss them. If I write them now, then we come for question. Italeta shida watu wamesahau the approaches. So we'll mention them, we write, then we go to questions straight. So today was the first remedial. It's a we are going to stabilize at 3 hours. Today we delayed because I was trying to set up the unlimited. So moving in the future, up to next week, you'll have 2 hours, but we are going to stabilize at 3 hours. Then it will be okay. Otherwise, for those who are going to charge, have a nice service. Those who are not going, have a nice day. We shall meet in our next class, God willing. Thank you. You can log out.